Hi, I'm Paul.
And I'm Blake.
And we're the Knowledge Real Estate Group at Keller Williams.
If you've been paying attention to the news, you know that inflation is high and the cost of living is increasing almost everywhere. At the same time, home values are increasing and property taxes are rising with them. Today, we're going to take a look at the question, if you want to make a wise real estate decision in this environment, what should you do? Should you sell or should you rent?
So Blake, there are two main ways for homeowners to get value out of their current properties. First, you can sell your home and get your equity out of it. However, a less conventional strategy is becoming more popular, and that's converting your primary residence into a rental. Should you sell your home or turn it into a rental property? Does the home have the potential to become a profitable investment? Let's unpack these questions and take a look at how to go about converting your primary residence into a rental and whether or not it is a smart thing to do.
So how do you go about converting your primary residence into a rental? First, you need to speak with your lender if you bought the home in the past couple of years and haven't paid off your mortgage yet. If you try to rent a house without telling your lender, you could potentially be breaking the law. You see, loan programs and lenders have varying rules about if and when you can rent your house after purchasing it as your primary residence. In most cases, if you finance the home as a primary home, you'll need to live there for at least 12 months before you turn it into an investment property. However, be sure to check with your lender, as we've seen lenders make exceptions to their occupancy requirements and actually allow owners to rent their home sooner. Next, you'll also want to check local laws and HOA regulations to make sure it's legal for you to convert the home into a rental. You see, some HOAs in local jurisdictions have restrictions in place and specific processes that you'll want to follow, and you'll absolutely want to know about these right out the gate when considering to rent the property.
There are many pros to converting your primary residence into a rental. For example, you could have a steady stream of passive income you could use to invest in other areas. Rents have been rising all over the country, so you may be able to make more money from your rental than you think. To calculate your passive income potential, you'll need to account for your monthly mortgage payment, the landlord insurance, the property taxes, and maintenance and upkeep. There are also many tax benefits to rentals, the most important one being the depreciation expense. This is an exemption for general wear and tear, and it could make all of your rental income tax-free. If you'd like to learn more about how this exemption works, or if you would like help calculating the cost in return from your rental, please reach out to our team for details and assistance on how to be able to calculate that.
So when it comes to turning your primary residence into a rental, unfortunately, there's some cons to consider as well. You're likely dreaming of a tenant paying your mortgage, but managing a rental takes more time and energy than just making sure the rent payments hit your bank account each month. You see, being an owner of a rental property comes with financial risks, and those include unexpected repair costs, tenants who may or may not pay rent, or maybe even a slowdown in the rental market and decreasing rental rates. You see, maintaining a rental can be a full-time job, so we usually recommend to hire a property manager to help manage the investment for you. Typically, you can expect to pay about 1% of your property's total value a year in maintenance costs. Through our 20 years in real estate, we have built relationships with amazing property managers locally and actually around the whole country. If you'd like an introduction to one of them, please reach out to us and we'd love to share their information with you. Another potential downside is you could also potentially forfeit the ability to exempt yourself from capital gains taxes when you eventually sell. You see, this is because the law states that you do not have to pay cap gains on a property that you've lived in for 2 of the past 5 years. Now, there's ways to get around this using a 1031 exchange. However, you'd have to use the funds to purchase another investment property, so your options are going to be more limited. Now, if you have questions about the tax implications from selling or renting, which you will if you're considering this, please reach out to us so we can set you up with our CPA and get your questions answered. This is Blake.
And this is Paul.
And we
hope you make it a great day.